Hey everybody, Rob Maurer here, and today we are going to be going through what to expect from Tesla's Q1 earnings report tomorrow. I'll go through my forecast as well as analyst consensus. We'll take a look at some of the differences there, and then we'll talk about key points to watch for as we get that shareholder letter, and of course the earnings call following that, with that beginning at market close tomorrow afternoon. So before we even get into the forecast, I think we all kind of know what this earnings report is about, right? We've seen the huge price cuts here in the first quarter, and everyone's big question is how significantly that has impacted Tesla's margins and what that means going forward. As always, when we walk through these numbers, that's the focus. We're not super worried about how forecasts come in versus, expectations. It's more about what do these numbers mean? What additional context do we learn from this report that will help us understand where Tesla's business is going forward. So as we look through these numbers, you're going to see that I am pretty close to analyst consensus. We've got the trailing 12 months, so the last 4 quarters on the left, my forecast in yellow, and then on the right, we've got the analyst consensus. And right off the bat, you'll probably notice that the analyst consensus doesn't actually have as much information as we're normally used to seeing. So that's not a difference with the analysts. They're still projecting these things, but the company compiled consensus has been pared down, parsed down a little bit, to include a little bit less information. So whether that's an indicator of maybe Tesla changing some of their reporting styles or something like that for the earnings report tomorrow, we'll have to see. Could just be, Tesla trying to focus a little bit more on some higher level numbers, and they'll still include those things. But it is interesting to see kind of that change in what is being shared in terms of that consensus. So just something to keep an eye on as we get that report tomorrow. But as we go through my forecast, obviously we'll start off with deliveries. We already know that number, pretty close to what it was, or we already know that number because of Tesla's previous report at the beginning of the quarter, or at the end of Q1 rather. For energy storage, this could be where we see some significant differences. I've got energy storage projected at about 3.1 gigawatt hours, up from about 2.5 gigawatt hours in the fourth quarter. Analysts only at about 2.3 gigawatt hours. So our consensuses in general are pretty close, but that is one area that I am a little bit different. I did bring that down slightly from my forecast earlier in the quarter based on the Megapack production numbers that we saw from Bradford Ferguson, which we had talked about last week. Seemed like that was roughly extrapolating to about 3.5 gigawatt hours per quarter. So for them to be at 3.1 for the first quarter would be somewhat in line with that production rate. But of course you have power walls and things like that that are going to add to that total, not just Megapacks. So that's where I'm at for energy storage. Energy generation, so solar, I'm at 100 megawatts, just in line with last quarter. That's kind of where we've seen Tesla be for the last 3 quarters. Q1 last year was a little bit of a drop, but the quarter prior was sort of around this level as well. So I'm pretty much in line with analysts on that one. So getting into the revenue buckets, this is, kind of where everything starts, right? Everything will trickle down from this, and this is going to be dependent upon average selling prices for Tesla's vehicles. The big fluctuating factor there is going to be that ASP combined with whatever the energy storage numbers come in to be. So those are going to be the 2 driving forces for where earnings starts at this top line with revenue. I do have Tesla revenue coming in a little bit higher than expectations at about 23.4 billion versus analyst consensus 23.25 billion. So for me, what's driving that is actually not automotive revenue. I'm slightly below analyst consensus there, about $100 million. Again, we don't have the analyst consensus for regulatory credits, so it's tough for me to know if they're expecting more regulatory credits or a higher average selling price. When we look at margins a little bit later though, I think it suggests higher average selling price expectations for analysts than where I'm at, which we'll talk about more in a second. But really what's driving the energy, or what's driving the revenue beat for me versus analyst expectations would be energy. So I'm at about 1.4 billion versus them at about 1.2, obviously driven by that additional storage. So for services, I'm a little bit higher, $70 million higher there. Just continuing to see some growth as Tesla tends to show over the last few quarters. So I'm a little bit surprised that analyst consensus is a little bit lower there, but we'll talk a little bit more about that as we get into margins as well. So again, the big critical factor here, average selling prices. This is the key driver for this entire earnings report. So I just want to take a second and look at a comment that Zach Kirkhorn, Tesla CFO, made last quarter on the earnings call. So this was actually late January by the time Tesla had the Q4 earnings call. And the question that was asked by investors through say.com was, after recent price cuts, analysts released expectations that Tesla automotive gross margin, excluding leasing and credits, will drop below 20% and average selling price around $47,000 across all models. Where do you see average selling price and gross margins after the cuts? So Zach responded to that saying, yes, I'll jump in on this. So there is certainly a lot of uncertainty about how the year will unfold, but I'll share what's in our current forecast for a moment. So based upon these metrics, we believe that we'll be above both these metrics that are stated in the question, so 20% automotive gross margin, excluding leases and credits, and then $47,000 ASP across all models. And so 2 other comments I want to make on this just tactically on sequential ASP changes from Q4 to Q1. Just as a reminder, the ASP reduction is not as large as the reduction in configurator prices, as in Q4 we had backlog customers that we're delivering cars to at a lower price book, given that backlogs had been so long for much of 2022. But then also there are various programs in place that we used in Q4 that lowered ASPs. So of course we know about that, Tesla giving $7,500 discounts towards the end of the quarter on many vehicles in the United States and other incentives in other regions. So as we come back to the financials, again, these things that were shared here give us a lot of insight into where Tesla expects things to come in. Probably the most uncertainty that I've got around these comments is whether or not Zach is talking about this quarter specifically, Q1, and these results that we'll see tomorrow, or if he's talking about Tesla's average selling price for the year. So we may see the numbers dip below that and then, return a little bit higher as Tesla gets costs down early or later on in the year. But right now, we could see margins dip below that if Zach is talking about on an annual basis. But the question, it seemed to be a little bit more around if the numbers would drop below that at all. And it seemed like Zach kind of answered in that way. So I'm just a little bit 50-50 on what exactly was meant there and if Zach is talking annually or for the year. So just keep that in mind as we kind of return to the forecast, because the next section we'll look at here is for average selling price. So you can see how that has trended over the last 4 quarters. I've always had this in my more robust model, but just adding it here on the summary because it is so important this quarter. So you can see it's gone from 52,000 up to almost 56,000 in Q2 last year, dropping a couple thousand then each quarter from Q3 and Q4. And now I have it at about 47,800. So if we go back to that main question, or we go back to that question from the Q4 call, Zach is saying it's not going to drop below 47,000. So I've got that in my forecast. It seems like analysts have that in their forecast too. They're probably a little bit higher, again, based on those gross margins. Not sure if that's coming from regulatory credits or ASP, but seems like from ASP. And then on the cost side, I do have those declining as well. So we've seen that a little bit, from Q2, sort of peak cost there, as well as peak ASPs. But those have, at least in Q4, sort of leveled out in terms of the decline that we saw. That said, I do have this quarter costs coming down a little bit more. The main reason for that is that Tesla has continued to ramp up at Giga Berlin and Giga Texas, and that should help with costs. I think one of the big drivers of Tesla's cost of goods sold here, you can see these really increase. A lot of this happened when you've got the R&D expenses for particularly 4680 cells, the development there, flipping into cost of goods sold as Tesla, really started full production of 4680 vehicles there in the second quarter. So you can see that, you coincide here a couple $100 million of R&D drop with a increase in the average cost of goods sold. So that's kind of when Tesla flipped the switch on 4680s, hitting cost of goods sold, and that has persisted. I think Zach mentioned last quarter that was about a $2,000 to $3,000 impact on the average costs. So I'm projecting a little bit of that to come out, as well as just a little bit of a decline in Tesla's materials prices, as of course we've seen things like spot prices for things like lithium, nickel, various other materials that Tesla needs to use come down from sort of the bubble that they were in. What we don't know is how significant that will impact Tesla's costs or at what point in time. Zach talked about how this will take some time to flow through. They're not going to see the benefit of some of those lower costs immediately just because of lengths of contracts and things like that. And that's sort of, not that it was, I guess if you want to call it a bubble, it's not the most inaccurate portrayal of it, but because of a little bit of a lead time of those increases in costs, not hitting Tesla's costs immediately, while they were raising prices throughout 2022 and probably the back half of 2021, those prices were coming in higher, but cost of goods sold were not, because those contracts were supporting Tesla's materials prices. And now we're kind of on the opposite swing of that, right? So you've got a little bit of a inflation in the gap between these two metrics back at that period of time. And now you've got probably the opposite, where prices are coming down, but maybe the materials changes aren't quite hitting yet. So we'll see on that. And hopefully they'll share a little bit more commentary on how they expect that to unfold. They talked a little bit about that in Q4. on the earnings call. So again, I'm spending a lot of time on this because this is really the fundamental driver of how the earnings come in this time, but also how the market is going to react to it, and basically forecast from here. This will set sort of the benchmark for where we go for the rest of the year. And obviously Tesla since then, since the end of Q1 has had some other price changes. So if this number disappoints, that's going to cause some concern around expectations for the following quarters. Thank you, Winston, for that super chat. I really appreciate that. All right, so looking at automotive profit, again, this is just a function of how these ASPs and average selling costs or average cost of goods sold come in. And unfortunately, we don't have the analyst consensus, but I'm at about $4.4 billion here. More importantly, though, that ends up being a 21.5% gross margin. So you can see how that compares to how it's come in the last 4 quarters. It is a pretty significant drop. From an X credit perspective, again, I had $320 million in credits, kind of just taking the average that Tesla seems to come in at, maybe a little bit low on that, but excluding those credits, I'm at 20.3%. So again, if we go back to this answer, I'm kind of taking that. However, the question here was excluding credits and excluding leases. For me, I do have leases included in this number right now. If I exclude leases, my number there is 19.6%. So I'm actually being conservative in terms of my margin expectations compared to this answer. Again, based on that uncertainty of not knowing if Zach is talking about for the year or for the quarter in this case. As Tesla unfolds again throughout the year, hopefully more of those materials cost declines hit their books, as well as the impact of 4680s and the ramp there, as well as just the factory ramps for Berlin and Texas, which were 25 to 30% ramped up in the first quarter. As those costs come down, that will hopefully improve Tesla's cost structure, which can improve margins as long as average selling prices don't decline even more significantly. So I'm a little bit conservative there, I hope. If Tesla, sort of every 1% in margins that Tesla adds, based on the automotive revenue that I've gotten here, it adds a couple $100 million in automotive gross profit. That usually will trickle all the way down. There will be some tax impact, but that probably adds about 5 cents to earnings per share, which we'll talk about here in a second. So that's where I'm at for automotive gross margins based on this cost structure. Now again, this could be a little bit lower. No one really knows how these are going to come in because we don't know the mix of Tesla's orders that are new orders and sort of their backlog. Not even so much for this quarter, but for last quarter or the prior quarters. So we don't know how the mix of those vehicles was impacting the average selling prices here to be able to use that as a basis to establish our average selling price for this quarter. So again, that's why this quarter is so important to see what this number is, because it'll kind of reset expectations, because presumably when Tesla lowered those prices, there's probably not going to be a bunch of people taking delivery at the older high prices. So it'll help reestablish for forecasting going forward. Energy profit, again, not broken out for the analyst consensus, but I'm at about $200 million, so up a little bit, and at a 14% gross margin there. Services and others, I do have that declining a little bit, still up significantly year over year, but I have the margin declining to just below 2% for services and others from about 5.5% last quarter. The main reason for that is because of just the decline in average selling prices that we're seeing in the automotive market. Tesla has talked in the 10Qs about how part of what has been driving these higher gross margins in services and others has been used vehicle sales. So if average selling prices are compressed a little bit for used vehicles as well, that'll impact services and others gross margin. So I think those are the main things that I want to say about the margin structure. Probably worth pointing out, one other thing. So when we look at the sequential change, you may notice that this 400 basis point drop is what I'm forecasting. It's actually a little bit less than that because, as we talked about when we got the last quarter's earnings, these were pretty heavily impacted by Tesla recognizing about $325 million of FSD revenue. If you exclude that from last quarter, which you should to kind of establish a fair comparison, that would put last quarter automotive gross margin X credits at 23.1%, so takes about 1.2% away. So really, the drop is less significant sequentially if the numbers come in how I'm forecasting. And then same thing for total gross margin. That takes about 1% point out. So you're at a 22.7 versus 23.8. So you can see how that compares sequentially as well. And then for the year-over-year comparison, obviously we're seeing a huge drop here. If you look at gross profit down 16% despite deliveries up 36% in this forecast, total sales up 25%. So this is a huge reason, as we have talked about, for the multiple compression that we have seen for Tesla. If you strip out everything else from Tesla and you just kind of look at the financials, which isn't the best way to analyze a business, but as we know, that's something that people do, especially on Wall Street. If you strip out all that context, these numbers in isolation, they don't look good. You don't want to see a business that's growing revenue that significantly, generating economies of scale, start to see declining profits, because then the question is, okay, how are they ever going to grow profits if increasing scale isn't doing that, right? So the question becomes, is this sort of a reset for Tesla where, okay, this was a little bit of a bubble, now we're maybe in a little bit of a reverse bubble to an extent, maybe that continues for some period of time. But if this can sort of reestablish a baseline and Tesla can continue to grow from here as we have seen historically, then it's kind of all good. You just don't want to see this continue. But that's a lot of what we've talked about for the share price over the last sort of 9 months or so. The other thing I wanted to mention on the gross margin comparisons to last year. So when we look at last year Q1, it was obviously a tremendous quarter for Tesla, 29.1% total gross margin, almost a 33% automotive gross margin. Significant drop from where we're at today, or to where we're at today. But a big driver for that last quarter or last year was the $680 million in regulatory credits, which is, I think, the biggest ever that Tesla has recognized. So if you strip that out, that does take about 3.6% from Tesla's, gross margin or operating margin. So it, still a tremendous quarter, excluding those things, but it does also make the comparison look a little bit worse because I don't have nearly that amount in Q1 this year. All right, so getting into operating expenses, operating margin. So this should be pretty straightforward. This has been relatively predictable for Tesla over the last year. And even before that, it was a little more predictable than Wall Street was able to do. But they've kind of got it locked in now, I think. So unless there are any surprises, there shouldn't be, any major swings for the operating expenses. Like we've got Elon Musk's compensation plan out of the way now. There's nothing there to continue to recognize, which was a big driver of some of the volatility in the past. So that's out of the way. R&D has kind of been pretty smooth with the exception of the 4680 stuff. But once that's fallen out, the growth there has been relatively consistent. Same thing with SG&A, which again has also been impacted by Elon's compensation plan. So a lot of the things that drove volatility in those, as far as we know, are out, again, pending any surprises. But since we have a pretty decent idea of how those are going to come in, we should see operating expenses around 1.9 billion. So again, operating margin will just be a function of pretty much average selling price and cost on the vehicles, with a little bit of contribution from energy. That being said, I'm at about 11.5%. Currently, analysts are at about 12.3%, so I'm a little bit lower than consensus. Same thing with total gross margin, which we didn't talk about, but again, I think that what's driving their total gross margin up based on probably pretty low expectations for energy and services, it would pretty much have to be automotive gross margins doing that, driving that difference. So they're a little bit higher on that, which is driving the operating margins up a little bit as well. Then in terms of the bottom line numbers, we'll talk about GAAP net income here. So I'm at about 2.5 billion. Analyst consensus about 2.5 billion. So we're pretty much in line. I'm guessing they have a little bit higher forecast for things like interest expenses or taxes is kind of what would drive those differences. But ultimately, we end up at pretty much the same situation, although with different inputs getting there. I'm at about 84 cents from a non-GAAP earnings per share perspective versus 85 cents on the consensus. And I'm at 72 cents for GAAP EPS versus 73 cents for analysts. So that's kind of how it all shakes out with these numbers. Again, hopefully there is some upside if gross margins can stay above that 20%, excluding automotive credits and excluding automotive leases. If that's the case, this should add 5% for every 5 cents in earnings per share for every 1% of gross margin that Tesla can exceed that by, roughly. So, you could be looking at maybe 10 cents of upside from that. There could be regulatory credit sales that Tesla has. Last quarter was higher. Last year, this quarter was higher. That could drive things up significantly. So those would be some of the factors that could lead us to a beat, which would be really nice. Less so on the regulatory credits. No one really cares about how that affects things because they're inconsistent. And, if you're modeling out to 2030, perhaps not part of the projection. So that's kind of where the bottom line sits for me right now. again, I think analysts have gotten a little bit better at forecasting. It's gotten a little bit easier over time. Now that I say that, though, we'll probably have some big surprise that comes in. And just to be clear, I think I mention this every quarter, but these have been my forecasts for a long time. I do these before I look at any analyst consensus, so it's not influenced by those at all. And this has actually been my forecast since January. So this is within, I think, a cent or two in earnings per share of what I had expected the day following Q4's earnings. So that doesn't mean it's right, but it's been consistent since we've, sort of had that last big piece of information with that Q4 call. All right, I'm trying to think if there's anything else major to note here. Just a couple of other things to keep an eye out for as we look at the call. We did have a significant impact from foreign exchange last quarter. This is something that I don't really model in. It's not something that I'm really particularly well suited to do, I don't think, or not my skill set that has developed yet, I guess. But the foreign exchange impact was, I think, $300 million or so last quarter, and it's difficult to forecast because Tesla doesn't really hedge it. And obviously there's so many different influencing factors there with Tesla playing in so many different markets. And then the other big thing would be just Tesla's comments on the outlook going forward. Whatever the margin is here, if we get some sort of an update on anything relating to this, that will help people model out forecasts for the year going forward. So that's kind of where we're at. If you've got other things that you're keeping an eye on, definitely let me know in the comments today. If you disagree with any of these forecasts, let me know that as well. But again, generally just trying to provide some context so that once the numbers come in tomorrow, we've got some idea of what we're looking at and kind of what that means for Tesla's business going forward. But that'll wrap it up for today. So as always, thank you for listening. Make sure you're subscribed and signed up for notifications. You can also find me on Twitter at Tesla Podcast. And we'll see you tomorrow for earnings day for the April 19th episode. Couple of episodes, I guess, of Tesla Daily. Thank you.